Hi everyone, welcome to Deloitte's Dbriefs webcast series in Asia Pacific. Our webcast today is from our Geography Updates series and is titled Updates to Singapore's Fund Tax Incentives. My name is Joyce Khoo and I am a director in the Financial Services Tax team in Deloitte, Singapore. I have the pleasure of hosting today's webcast. Let me first introduce today's speakers, Matthew Lovett and Clan Yeo, both partners from the Financial Services Tax team as well in Deloitte, Singapore. They will share updates to Singapore's fund tax incentives, as well as industry insights and the regulators' expectations in compliance with the updated requirements as we go along this session. We will also highlight that as our session today is only for 60 minutes, we have focused our update sharing and discussion on non-single family office, non-SFO funds instead of SFO funds. You may access our bios on the left side of the screen. Before I introduce the agenda for today's webcast, I'd like to take a moment to highlight some of the features of our webcast console. First, all users are on listen-only mode. If you have any content-related questions, you can submit at any time in the Q&A box at the bottom right of the screen. We have allocated 10 minutes at the end of our session for Q&As, and hopefully we are able to answer all questions raised during this webcast. If there are any questions that we are unable to cover during the session, we will follow up with you offline by way of email. Second, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen. If you want to download today's slides and related publications, please go to Downloads and Links box. On the other hand, mobile device users can view the slides and answer the survey on screen. Thirdly, if you require an attendance record for this event, you will receive an automated email with CPE certificate after watching the webcast for 50 minutes. Now, with the housekeeping matters out of the way, I would like to walk you through our agenda for today. First, Clem will provide an overview of the current landscape of the fund industry in Singapore, setting the scene for a deeper dive into discussion on fund tax incentives. Second, Matt and Clan will take us through some of the key recent changes to the tax incentive schemes for funds managed by fund managers based in Singapore. Third, we will take a look at some commonly asked questions, both by our fund clients and advisors, and provide some insights to address them. Last but not least, as mentioned before, we will open the floor for Q&As. Without further ado, let's hear from Clan. Clan, why don't you share with us about the present state of the fund sector in Singapore?
Thank you, Joyce. Can you hear me, Joyce?
Yes, I can hear you.
Hello, everyone. My name is Clan Yeo, and I'm the tax partner in Deloitte, Singapore, who is fully focused on asset management clients. Thank you for taking time to join us in this webinar to update you on the fund's tax incentive changes in Singapore. We have an overwhelming number of signups, and I can see that participants continue to log in. Maybe, Joyce, we can show our next slide. As MAS promotion of fund tax incentives is to help to grow Singapore's fund industry, I often get asked questions such as how many VCCs are there in Singapore? What is the AUM managed by Singapore fund managers? Let us therefore start this webinar by looking at some of the highlights of the 2023 Singapore Asset Management Survey released in the third quarter of this year. So this is one survey that is released about the third quarter of each year that reflects on the results of the previous year. As you can see in this infographics, the AUM in Singapore has grown by around 10% to 5.4 trillion Singapore dollar in 2023 from the previous year. This amount of Singapore AUM is nearly at the peak AUM in the recent years. Next slide, please. The chart on the left shows the source of Singapore's AUM. The top AUM contributor comes from Asia Pac, followed by Singapore and then the North America. It is noteworthy that 77% of the AUM is actually sourced from outside Singapore, which is an increase from the previous year. And this shows overseas investors' continued confidence in putting investment monies in and through Singapore. Moving on to the chart on the right, this shows the breakdown of the broad regions that the Singapore AUM is invested into. The majority gets invested into Asia Pac, which is reflective of our experience, followed by North America and then Europe. Next slide, please. With respect to the growth of the alternative funds AUM, much of this growth was driven by asset value recovery and net inflows. You can also see the growth by asset classes into PEs, VCs, which is up by 12%, REITs up by 14% from the previous year, hedge funds up by 5%. On the other hand, MAS had an observation that the real estate experienced a slight dip as higher cost of financing dampened the investment activities. Shall we move on to the next slide? Here we want to show you the number of Singapore licensed and registered fund management companies, which have also increased from 1,194 in 2022 to 1,250 in 2023. This number will, of course, be even more significant if you add fund managers that are exempted from fund management licensing, such as those that solely manage immovable properties or manage single-family offices. As of 31 December 2023, 1,029 VCCs with 2,158 sub-funds have been incorporated. All of these are exciting growth in the Singapore asset management space. Back to you, Joyce.
Thanks for sharing, Clan. All the data seems to be showing a very encouraging trend, and perhaps that growth will be fueled even further by the recent changes to the tax incentive schemes.
Yes, I would think so. There are some really positive changes that MAS has introduced, which shows that they have taken on board past feedback from our asset management industry.
Sure. Then perhaps it is a good time to segue into the recent changes to tax incentive schemes. As our audience would have already known, MAS recently issued a circular FDD 10/2024, setting out quite a few changes to the tax incentive schemes, which mainly affect non-SFO funds. Matt, why don't you tell us a bit more about these changes?
Sure, thanks, Joyce. So at very high level, the key changes to the incentives are the 13.0 resident fund exemption, the new 13.0A extension of that to limited partnerships, and the 13U enhanced tier fund exemption. Singapore dollar 200,000 total business spending conditions will be replaced with a tiered local business spending requirement from next year. And that tiered requirement will range from 200,000 to 500,000 Singapore dollars based on the AUM of the fund. Furthermore, note that there's been a move away from total business spend in certain cases to local business spend. Now, in addition to the spending conditions having changed, sections 13.0A and U will also incorporate a new closed-end fund treatment that we'll go into in a bit more detail. But at a high level, that is intended to be an option that gives award applicants the ability to elect into a treatment that is potentially more advantageous for them to the extent they're operating closed-ended strategies. The other high-level change is that there's been an increase in the number of investment professionals to be employed by a fund manager, and that will be applicable to sections 13.0 and 13D only. Now, as I mentioned with respect to the local spend requirement, each of the changes will take effect with respect to periods beginning 1st of January 2025. Now, the slide that's on the screen at the moment plots those changes. Importantly, as Joyce mentioned at the outset, the changes are only applicable to institutional, that's non-single family office funds. The reason for that is that the economic conditions applicable to single family office funds were changed relatively recently, and the MAS chose not to amend them further for the time being. You'll also see from this slide that there's also reference to the new section 13.0A incentive, which is a new scheme that extends the benefits of section 13.0 to funds established as limited partnerships from next year. Now, this development was announced earlier this year as part of Budget 2024 and will be legislated when the current income tax amendment bill comes into effect. You might also ask why the conditions are being modified now. The short answer to that is that the increased level of scrutiny of tax incentives internationally has prompted a review of the Singapore incentive landscape. And there's been an overall trend toward adequate levels of economic substance and activity, which are considered to be objectively appropriate to justify the grant of incentives and exemptions. With respect to the funds exemptions, the MAS has therefore sought to strike a balance between being able to meet that expectation of substance, whilst at the same time ensuring that the exemptions remain fit for purpose, vis-a-vis supporting the growth of Singapore's fund management sector. If we could go on to the next slide, please. So you'll see that from a practical perspective, there's some good news and some perhaps not so good news from the changes. For Section 13U master-feeder-SPV structures, the fund complex will now only need to meet one set of economic criteria instead of additional AUM and local business spend for each additional trading feeder or SPV. Now, because of the changes, the distinction between trading and non-trading feeders will be complete when these changes come into effect from next year. There is also a waiver of the 30-50% rule for investors in 13D trusts and unit trusts for investors that are themselves 13O and 13D funds. That means that 13D trusts and unit trusts can freely invest in 13D and 13O funds now without a penalty being imposed. Changes in investment strategy will no longer require approval from the MAS, and going forward, simple notification of changes will become applicable. And with respect to 13O, there will be a change such that the requirement for an award applicant to be a newly set up company will be removed, therefore making the scheme much more flexible than it has been previously. That change also brings 13O much closer in line with economic criteria, that being AUM, local business spend. Number of investment professionals have been tightened. Those are balanced against the liberalisation of application of the schemes to ensure that they are functionally beneficial to a wider range of circumstances, which is intended overall to improve their utility. We could move on to the next slide. So focusing in on the master-feeder-SPV a little more, this next slide really illustrates how the change is intended to make it easier to satisfy the AUM and the business spend requirements. Now, you can see how the changes have a material effect in that the structure on the right from the 1st of January 2025 would have previously necessitated satisfaction of 5 instances of economic conditions. So if we look at the structure on the left-hand side of the screen, that 5 instances would essentially be 1 instance for the trading feeder at the top of the screen, 1 instance for the master, 1 instance for each of the 3 SPVs. That would have necessitated a cumulative AUM of 250 million Singapore dollars and a cumulative business spend 1 million Singapore dollars per year. But with the changes that are being made with effect from next year, the same structure will be capable of being set up and operated with only 1 instance of the economic conditions, i.e. 50 million AUM and 200,000 Singapore dollars of business spend. So that's a material difference that will hopefully make it easier to satisfy the administrative conditions and the award requirements on a go-forward basis. Now, that change has come about largely as a result of industry discussions with the MAS, through which it was conveyed that a relevant fund complex invariably operates as one functional unit, and that the multiple-fold application of economic conditions was not sensitive to that. So in making this change, the MAS has therefore brought the operation of the master-feeder-SPV basis of exemption much more in line with industry practice. We can move on to the next slide. Thank you. So this next slide is rather detailed, but the simple point to draw out is that with modelling, we've seen how the closed-ended fund election that will become available to 13O, 13OA, and 13U funds may be beneficial. So in the example, it is easier for the fund to meet the AUM and business spend requirements because the AUM condition only requires satisfaction from year 1 to year 5 of the award, and because the local spend requirement can be met with reference to the cumulative expenditure of the fund. Now, we'll go into these changes in a bit more detail a bit later in the session, but I think the point to draw out from this slide is that when making an election for a closed-ended treatment, it's worthwhile considering whether or not the actual election will be of benefit given the fund's overall profile, in terms of whether there is an expectation that cumulative treatment of the local business spend is likely to ease administrative requirements over the life of the fund, and also whether the AUM requirement will make satisfaction of the exemption conditions on a go-forward basis easier, given that they may be limited to only opening years of the fund. Now, in order to elect into the exemption or the treatment, a fund will be required to inform the MAS of its expected life, and an exemption award will be revoked from the fund's end of divestment period or immediately after its 20th year, whichever is earlier. Mentioned in a bit more detail a little bit later. So in terms of the overall package of measures, for easy reference, we've summarized on this slide when the new AUM, investment professional, and local business spend requirements will apply. As Joyce mentioned at the beginning, these slides will be available for download, and we'll leave you to digest this slide and some of the other finer detail in your own time. But a key point to note for existing funds is that there will be a grace period applicable, which means that the existing funds will only be required to satisfy these new requirements from financial year 2027 or which is year of assessment 2028. Such funds must, however, continue to apply their existing $200,000 total business spend condition before transitioning to the new requirements. Now, funds with awards commencing during financial year 2025 or 2026 will also be given a period. They will be given until the end of their third incentive year to satisfy the new AUM requirements. And however, will also be required to satisfy the professional and local business spend requirements in or after 2027 will be given until the end of their third incentive year to satisfy the new AUM requirements, but will be required to satisfy the investment professional and local business spend requirements from their first incentive year. So I guess the point here is that there will be grace periods. How the specific conditions will apply to individual funds will vary depending on the date on which the award comes into effect. It's worth keeping in mind that over the next 2 or 3 years, we will be going through a transitional phase. So do take a look at the detail, confirm what conditions will be applicable to your fund, and make sure that you have ability and clarity around the overall package. Is that the only change to the investment list was to clarify that equity-interested real estate investment funds are intended to include such funds constituted in any form. So foreign real estate funds that are constituted in a legal form dissimilar to that in Singapore or by way of undertakings or contractual arrangements will be considered designated investments. The main question this begs is, why are only real estate funds being added to the designated investment list in this form? And that's something which has come up for discussion at an industry group meeting post-publication of the recent circular, and it's something likely to be picked up with the MAS in the future. So with that, Joyce, perhaps like to hand back over to you to take us in.
Yeah, thanks, Matt.
Developments in a bit more detail.
Yeah, thanks, Matt, for taking us through an overview of the recent changes. Now, we thought it would also be helpful to do a deep dive into the revised requirements on a scheme-by-scheme basis, especially to do that with our audience today. Glenn, can you do the honors?
Thank you, Joyce and Matt. Let's look at each of the fund tax incentive scheme, what their rules are as they currently stand, and the key changes from 1st of January 2025. Shall we start with the changes to the 13U tax incentive scheme? Now, for each of the 13U fund's master, feeder, and SPV entity, we currently need to multiply the local business spending and AUM by the number of relevant entities. This is not commonly known in the market as the economic conditions. This multiplication requirement will be gone from 1st of January 2025, which is great news. Do note, however, for existing standalone 13U funds that would like to move towards a fund structure, such as a master feeder fund, or a master feeder SPV fund, or master SPV fund structure, a fresh incentive application is required. MAS approval is also required to add feeder funds and SPV. Next, a 13U fund will only need to update MAS if there is a change in investment strategy going forward from 1st of January 2025. This is again great news, which does away with the admin or when the investment team goes ahead with its investment and inadvertently forgets to update the finance or operations or tax team to get in touch with MAS ahead of a new investment strategy. All of these are now a thing of the past from next year. Number of investment professionals have not changed. It has not increased any further than the minimum 3 required, which is again good news. As for asset under management, the AUM now no longer required to be measured in terms of the NAV, but in terms of the value of the designated investment, or DI for short. Specifically, from 1st of January 2025, a 13U fund must have 50 million Singapore dollar of AUM in DI at the point of application and at the end of each financial year. This change also means that it does not matter anymore whether the fund is funded by equity or shareholder loans. It also follows that to the extent the fund takes up external loan towards investing into DIs, it counts towards end of the year AUM. Next, on the annual local business spending, it is currently at 200,000.
Hi everyone. I think we lost Glenn there, so apologies if there was a little confusion. I think I can see him just coming back. So Glenn, can you hear us?
The amount of reliance on technology, I think that was a classic case of being failed by technology. Apologies for that. Matt, can you hear me?
Yeah, we can hear you. I think we lost you at the point that you were talking about the local business spend. I think you were just about to touch on the new sort of tiered system, if you'd like to pick up there.
Yes, that's right. Which is probably the start of the not so good news. And the technology just decide that's it. Jokes aside, the tiering works as this. It remains to be Singapore dollar 200,000 for AUM less than 250 million Singapore dollars. It ramps up to 300,000 for AUM of 250 million to 2 billion. And it goes further up to 500,000 for AUM of more than 2 billion. I appreciate that all these changes are significant. And as Matt briefly mentioned earlier, there is a grace period for compliance with the new changes. For 13U awards commencing before 1st of January 2025, they will only need to meet the new AUM in DI, investment professionals, and tiered local business spending from financial year ending 2027. This is the 2 years grace period that we have been talking about. So for applications that have been outstanding for a significant time, it is worthwhile for your advisor to follow up the status of the approval with MAS closely now. Of course, the 13U fund must continue to fulfill the 200,000 Singapore dollar total business spending in financial years before 2027. The changes will apply immediately to all new 13U funds approved from 1st of January 2025. Let's move on to the next slide, which shows you the 13O tax incentive table of comparison. Changes similar to the 13U scheme are mainly as follows. No MAS approval is required for change in investment strategy. It becomes a simple notification from next year. The tiered local business spending is similar to 13U as well. The changes specific to 13O fund tax incentive are as follows. 13O fund does not need to be a brand new company from next year onwards. Currently, 13O applications require the applicant company to not make any investments prior to the application, but this will now change and be removed, which is good news. Going forward, a 13O fund must be managed by a fund management company that employs at least 2 investment professionals. The 13O fund must have 5 million Singapore dollar of AUM in designated investments at the end of each financial year throughout the incentive period. Let's move on to the next slide, 19. Similar to 13U, there is a grace period for compliance for awards commencing before 1st of January 2025. Awards commencing between 1st January 2025 and financial year end 2026, the 13O fund will have to meet the $5 million AUM in designated investment requirement by the end of the 3rd incentive year and maintain that every subsequent financial year and meet the investment professional and tiered local business spending requirement only from financial year ending 2027. As for awards commencing from financial year end 2027, they will have to meet the AUM requirement by the end of the 3rd year and maintain that every subsequent year, the investment professionals and local business spending requirements will have to be met from the 1st incentive year. So next, we are going to talk about the 13OA tax incentive scheme, which is effective from 1st of January 2025. As this incentive is meant to extend the 13O incentive to funds constituted as limited partnerships registered under the Limited Partnerships Act 2008 in Singapore, it is particularly relevant for smaller PEs and VC funds raising money from institutional investors that prefer to invest into a limited partnership rather than a private limited company. The conditions for 13OA incentive are the same as the updated conditions for the 13O incentive and will apply at the limited partnership level. In other words, there will be a look-through treatment at the fund level such that the partner of the 13OA limited partnership can avail of the tax incentive on this investor's share of the specified income in respect of the designated investment derived by the approved fund. The compliance deadlines are exactly the same as those for the 13O fund tax incentive. However, do note that the general partner will be responsible for meeting the incentive conditions and submitting the annual declarations to the MAS regarding the fund's compliance with incentive conditions. Let's move on to the next slide. And finally, let's bring up this 13D table, which continues to be self-administered. However, from financial year ending 2027, the 13D fund is required to be managed or advised directly by a fund management company in Singapore with at least 1 full-time investment professional for each financial year, who is either a portfolio manager, a research analyst, or a funds trader. Given that 13D is self-assessed, you might be wondering if past relevant experience, similar to the ones that is currently reviewed by MAS for the 13O and the 13U fund, would apply here. MAS has clarified that there will be no requirement on work experience, educational qualification, or salary requirement for 13D's investment professionals. Lastly, to encourage 13D trust or 13D unit trusts to invest into other 13D funds, these are now qualifying investors for 13D purposes from next year. I'll just pause here for now, Joyce.
That's really insightful. Thank you, Clan, for taking us through the changes in a more comprehensive manner. Now, Matt, Clan, as you would know, after the changes were published, our clients have come back with some questions. I'm sure our listeners here will be interested in some of the FAQs that we have received. We have set out some of the FAQs with our take on what the answer could be, should be, based on our interpretation of the MAS circular as well as consultation with the MAS. Now, let us start with maybe scenario one. So, in scenario one of our clients has raised this question. How does the 13U committed capital concession interact with the new definition of AUM? Clan, perhaps you can take us through this one?
Sure, Joyce. Let's recap on the committed capital concession concept. This concession is usually taken up by funds which apply for 13U, but has not drawn down the minimum AUM required, which would be 50 million for standalone 13U fund, or up until end of this year, you got to multiply that by the number of fund entities within the 13U. You can therefore see on the left of the slide that the MAS allows the use of committed capital concession for each year, where the fund remains a real estate or infrastructure or private equity, and this could be a fund of funds, a debt or credit fund. The fund also requires to show a level of committed capital that must be legally enforceable through a contract between the investor and the fund, i.e. the fund manager must be able to have legal recourse on the day of the drawdown where the investor has not provided the monies, and the fund must also demonstrate that a component of the payments made to the fund managers is charged based on committed capital. This could result in the fund having to meet a higher local business spending because the AUM test is the higher of the committed capital or total AUM drawn down, which is naturally the former at this stage, particularly for those that might have committed capital of a huge number, such as more than 250 million, but the drawn down amount is, say, less than 50 million. What fund managers should do in such a scenario is to put an internal control in place, such that once the funds drawn down exceed the minimum $50 million required, the fund manager should write to MAS, supported by documentary evidence that it has met the AUM in designated investment requirement, so that subsequently the fund will not need to meet the conditions set out during the committed capital concession phase, but be able to go on to the 50 million AUM in DI at the end of each and every financial year.
Thanks, Clan. Thanks for the clear explanation of how the rules interact. Next, we have also received a question on whether it is worthwhile for a fund to opt in on the closed-end fund treatment. So this is scenario 2 in our examples. And what if if a fund were to opt in on such a treatment, what they would need to do? Matt, you covered this earlier. Perhaps we could also hear from you on this.
Yeah, sure. Thanks, John. There are definitely upsides to electing into the closed-end fund treatment in appropriate cases, but whether it makes sense to make an election ultimately depends on the specific fund's profile. Now, whilst the exemptions are often used by funds, we also see them being used by clients, stakeholders, for purposes of platform vehicles elsewhere within the fund structures. And in such cases, applying economic conditions on a multiple fold basis can skew the economics. So for example, if you have holding companies, intermediate entities, SPVs within a structure, each of which has a separate award, having the local business spend at multiple levels can be problematic. Also, given that the expenditure of a particular vehicle may be higher in early years as opposed to in the longer term, can also make it more difficult to satisfy the local spend requirements on a sort of an ongoing basis. In addition, for closed-ended funds, you would expect there to be a deployment of capital phase and a phase at which investments are starting to be divested. And that begs the question that if there is to be an annual an assets under management requirement that is tested annually, does there potentially become a point at which it becomes difficult to satisfy that AUM requirement because you're operating a closed-ended strategy and you're in that divestment phase? So I think the closed-ended treatment is intended to try and address some of those issues. Whether or not it does make sense to make an election, I think ultimately goes down to the particular strategy, the point at which a fund vehicle with an award is that, as I mentioned,
Apologies, I think Matt is facing some technical issues and has dropped out of the webcast. Clan, would you be able to? I think Matt is dialing back in. Hey, Matt.
yeah, can I just check whether you can hear me?
Yeah, it's loud and clear now. I
Yeah,
think
thank you.
Matt, we probably
Apologies.
lost. No worries. We probably lost you at around the slide 25, and when you were going through the AUM requirement.
Yeah, thank you. So I guess the point I was just trying to draw out is that whether or not to make an election, I think is it depends on the particular entities, the funds, the platform vehicles profile. But at the same time, quite often we talk about the conditions and the exemptions being applicable to fund entities. But given this new election being available, I think one of the things that this does is really enable the exemptions to be applied in a sort of broader range of circumstances. From an administrative perspective, an election for the closed-ended treatment may be made at any time, but a key point to note is that once an election is made, it is irrevocable. The other point to note is that an election causes the revocation of any existing incentive award and causes the commencement of a new award. Now, when an election is made, the fund must declare the expected lifespan of the fund and the strategy, and it must subsequently update the MAS if there is an applicable change on a go-forward basis. One question that we, and I know industry will be picking up with the MAS about, is notwithstanding the fact that any existing award will be treated as being terminated and a new award being commenced, we're waiting to hear from the MAS as to whether or not the term of any existing award will be counted toward the assessment of which year you're in for closed-ended treatment. If we read the circular and apply sort of a black letter approach to interpretation, the answer to that is most likely no. But given that a number of clients have asked us about that, that's something that we're just trying to obtain some further clarification around. If whoever's in control of the slides could please move on to the next one, that'd be appreciated. Now, to just demonstrate the point about the advantages of the election and it being relatively fact-specific, we can perhaps revisit this comparison that we showed on screen a bit earlier. Now, on the left-hand side of the screen, we can see that without the closed-ended fund treatment election, it will be more difficult for the entity to meet the local business spend and AUM conditions, particularly in years 7 and 8 of the fund's life, because without the election, the fund must meet the usual AUM and designated investment, the usual AUM in designated life. But you contrast that with the position illustrated on the right of the screen, in which the fund makes the fund is only required to meet the AUM to 5. The local business spend requirements to be met cumulatively, and because of the election, necessarily that in years 1 to 10. The fund essentially becomes exempt from meeting the AUM condition in year 6 and meeting the local business spend condition in year 11 onwards. So you can see that if expected to go beyond 5 years, even 10 years, this election can potentially be beneficial, even if you don't have an expectation of a fund going beyond that time frame. Then depending on the particular profile and the points at which expenditure is expected to be incurred, it could still be relevant to consider the election given the cumulative basis of assessment, and that potentially making it easier to satisfy the exemption requirements if you were to elect into the fund. Point here is, I think there's a need for a little bit of modelling, something to consider, but do ask your advisors about this because it's definitely something that's going to become of relevance and something worth doing a bit of diligence around. Joyce, back to you.
Thanks, Matt, for taking us through that. Finally, we have kept the best for the last and have reserved this scenario 3 for Clan. Scenario 3 touches on the impact of the change in the definition of AUM, especially for existing 13U funds. Clan, could you take this?
Thank you, Joyce. Yes, let me try and untangle this. Perhaps let's start with the simple bits first. On this slide, we have set out the before and after change in AUM definition for 13U fund. On the left, you can see that under existing AUM definitions, i.e. AUM is the equivalent to the NAV, where a fund manager chooses to manage the ease of cash repatriation by capitalizing the fund with substantial amount of shareholder loans rather than just pure equity, there is a higher risk that a 13U fund may not be able to meet the AUM definition as it currently stands. On the right, with the new AUM in designated investment definition, one will only need to consider the AUM in relation to the designated investment and can safely disregard the liabilities at the fund level. In my view, this is the correct result because capital contributed to a fund, regardless of whether it is by way of capital injection or shareholder loan, they both form the fund's assets managed by the fund manager. Whilst this change in AUM definition has its appeal, there may be practical complexity. For example, how does one actually value the designated investment? Practically, the value of designated investment can fluctuate over time. That being the case, does that mean that the fund will have to conduct a designated investment valuation every year that can potentially increase its compliance cost? AUM in designated investments is a new concept which appears simple on the surface, but when one considers the practicalities, it may not be as simple as it seems. If for those who have the privilege of following through the MAS circular on this, beyond the consistent references to AUM in DI or AUM in designated investment, at the front of the circular, MAS then, in a much later page under an appendix where they set out the FAQs, introduced the concept that AUM in DI refers to the net amount of DI recognized as assets in the statement of financial position in accordance with the relevant accounting standard. Now let's have a further think about this. Different funds, either set up in Singapore or overseas, have different local or overseas accounting standards. Different investments and asset classes also have different accounting requirements to either be mark-to-market or apply cost accounting plus revaluation requirement or impairment or depreciation requirements. Does MAS expect the funds to apply such accounting rules when valuing the DIs? One would hope not, otherwise what starts out to be a great idea might not be so great in practice if applied in an unintended manner. The one single example MAS gave in that FAQ was where the net amount of derivatives recognized as assets is to be net of derivatives recognized as liability as a class of designated investment or DI. If this example is reflective of where MAS is currently thinking, then the clarification to the industry is that the DI value is based on the gross DI or capital contributed towards this investment. MAS's clarification will be welcome regarding this, given that we don't have much time before the turn of the new year, which is when new funds approved from 1st of January will be the first to apply these new rules. In fact, this issue has already been tabled for further discussions with the MAS. Another issue relating to the AUM requirement is that the new requirement for it to be satisfied at the end of each incentive year. But how can it be satisfied in the final year of a fund's life if the final investment is disposed before the year comes to an end? This could be less of an issue for a fund with multiple investments and its disposal program has been arranged in such a way that most of its significant assets are to be sold down before the least significant asset remains to be disposed. But this could be a material issue for other funds with single asset that does not have the luxury of arranging which asset to sell first, or another fund that has its most significant asset not yet sold only because of market conditions, or a VC fund which makes its returns purely in the form of gains, not regular yearly income, in which case its final year of its fund's life could possibly be the most significant time during which the exemption is actually needed. This is an area that MAS has acknowledged the need for further consultation. There are a couple of different options, including assessment when with respect to AUM at the end of the penultimate year of the fund's life, or just a day before the final disposal event. However, it's yet to be seen what MAS or MOF's preference might be, and we'll keep you updated regarding this once the industry discussions are further advanced.
Thanks, Clan. We can now see why the new definition can be tricky to apply. To the listeners, for questions which we have collated from industry and advisors alike that require further clarification, we have been engaging with MAS for further guidance and input. In the interest of time, these questions are now set out in the next few slides, and you can take a look in your own time after today's session. Where MAS has responded with clarification, we have also included that clarification in the slides. Now again, many thanks Matt and Clan for all your sharing. This has really been insightful. This brings us to the end of today's discussion. We have decided to extend the session by a couple of more minutes beyond 60 minutes so that we can make sure that we have at least 10 minutes dedicated to Q&A from the audience today. First, we have a question from the audience. The first question, I will read it out and I will then let either Clan or Matt take the question. So our first question today, for existing fund, perhaps in its third or fourth year, upon election of the closed-end fund treatment, we understand that existing award will be revoked and a new award will be given. Now, can the first to fifth year AUM condition be shortened to say first to third year, given that the fund would be in harvesting or divesting stage by third year of the new award when considering its original fund life? Matt, are you able to take this as it's the closed-end treatment, closed fund treatment that you have been covering so far?
Yeah, sure. Thanks.
Sorry, Matt, can you hear?
Can you hear me?
You have been breaking, Matt. If you could just repeat what you have just said in response to the question. Oh, Clan has dropped out again. Clan, would you be able to take this question?
Sure. So Joyce, thank you for the question. Unfortunately, right now, there is no mechanism such that we actually shorten the first to fifth year AUM. This is one area that we have raised to the MAS for consultation to make it more fit for purpose for funds with shorter life, as the participant has pointed out, using the example of a third to fourth year before actually divesting thereafter. And it's not uncommon that we see a closed-end fund, be a PE fund or VC or private debt fund, being a 5-year closed-end fund before, say, a +1 or even a third +1 extension, depending on the market conditions, whether the fund should be extended or not. One suggestion that we are making to the MAS is why not allow such a closed-end election to be based on that fund's life, rather than having that fixed 5 year or that fixed 10 years, and to actually do the AUM based on the fund's life, which in your example could be much shorter. We'll keep you updated once we have further clarification with MAS on this point.
As we have a bit more time left, we will now be going through some of the questions, and these are overlapping with the questions that we just got from the audience, and also some that we have already submitted and pending MAS further input and guidance. So, Clan, if I could just draw your attention to slide 29, would you want to take us through number 1 and 2 regarding AUM requirements? I think these are, slide 20, slide 27, 1 and 2. I think these are some that you have already shared during your, when you went through the scenario 3 with us. But these are some of the more obvious questions that MAS has actually responded. Clan?
Yeah. Maybe Joyce, you can read out the questions to the participants.
Yeah, I think so. So we're looking at that as displayed on the slide. We've received questions on whether the new definition of AUM apply to pre-existing fund vehicles. And we note specifically that some of these pre-existing fund vehicles in the award letters, the AUM has clearly been defined as NAV. So how does this then work or interact with the latest circular changing the definition of AUM to value in DI at the end of the financial year?
Thank you, Joyce. So we have clarified with MAS that the new definition of AUM will apply to pre-existing fund vehicles, as we have mentioned earlier in our webinar. MAS has also confirmed that its circulars are viewed to be sufficient to update incentive conditions rather than waiting for all these to be legislated down to the last condition. I think we have also confirmed the new definition would include both funds sourced from shareholder loans as well as external loans, to the extent that they are used towards the investments into designated investments. We
Thank you,
also
Ken.
mentioned
Yeah, go ahead.
that the beginning of this call, the changes, we do not intend to focus on single-family office funds, or what MAS calls it as SFO funds. We will run that through our Deloitte private platform with regards to the impact of that to SFO funds. And some of you who are more involved in SFO funds would have received our separate updates through emails as well. I think,
Thanks,
Joyce,
Ken.
we are to time out.
Yeah, that unfortunately is all we have time for. Thank you, Matt and Clan, and special thanks to all of you who are able to join us today. We would like to encourage you to fill out the short survey that will pop up on your screen momentarily and tell us what you think about today's program. If you join us late, please note that this presentation will be archived for future viewing. If you feel that others would benefit from this webcast, please share the webcast via the Share This icon or have them visit the Dbriefs website. We will respond to all the questions submitted during the webcast in a couple of weeks. Also, if you think of any other questions or comments later, please feel free to reach out either to me or to our speakers. We'll be more than happy to talk to you. At last, from all of us at Deloitte, thank you for your participation in Deloitte's Asia Pacific Tax Webcast today. Goodbye.